Welcome back to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III, and we're back here this week with Matthew Blades, one of our financial planners here and trusted advisors at Woodard & Company. He joins us here this week to talk about retirement. Kind of goes on our financial planning series. Matt was the one that is going to be doing the main deal of that. He's just well-rounded in all that whole field of things. But specifically this week, we're going to be talking about the key dates of retirement, so the important metrics and all those things. So we just welcome you, Matt, to the show.
Yeah, appreciate it. Yeah, this coming in from State Employees Credit Union after being there for 8 years, that was one of the big reasons that the company brought me in 5 years ago, was to be able to provide this sort of service, be able to talk to folks about a number of these major concerns. So big help. Been a great help to a lot of our existing clients. Been able to provide some advice to folks that aren't clients as well. So it's great to be able to help people and try and put them at ease with some of these big life decisions they end up making. So
that's great. And I've actually been lucky enough to sit in through a good few of the meetings now while I'm working to get my CFP, studying for that. Matt's let me sit in. So some of this is going to be learning experience for me, but also hopefully I have a few of these things down pat by now. But just so getting started here, can you tell me just some of those magic numbers for retirement? What are those that people are really looking for these days? If you'd like to just expand and kind of enlighten the audience on that.
Yeah, so it's one of the biggest topics that people call in with. Financial planning is very broad. It can cover a number of different areas, but the big one, the hardest one, is often can you afford retirement? And so people try to, during the working years, often are targeting a specific number, right? They want their 401k, their 403b, their various assets to get to a certain number because that's what they've been told they need to target to be able to live a successful retirement. So often that number is like 1 million, 1.5 million. It's varied from different folks across professions in terms of what they were trying to get to. So that's a big one, I would say. That's not necessarily the best way to go about it. When I do financial planning with folks, we're looking at a number of other areas. So trying to make sure that they're going to be able to accomplish their goals long term. So $1 million is great, today, but it's not, what $1 million was back, 10 years ago because of inflation, the change in prices of everything. So it doesn't go as far as it used to. So some of the numbers that people have been thinking about, that these target magic numbers, 1.5 million, and then you can take 4% off of it every year and be able to keep your principal. Those goals are probably well-meaning and helpful for folks that aren't involved all the time, but it's not a one-size-fits-all, right? It doesn't work for everybody. So it may be helpful for you to be working on something like that, but it's not necessarily going to solve your retirement solution. So.
Okay. So what would you say it as you said, it's kind of not one-size-fits-all, but what would you say are some other important numbers or activities, planning ideas to be doing instead of just focusing on that magic number that someone will be getting to?
Yeah. So instead of focusing on one specific 401k balance, because the markets are volatile, they've been great for us these last few years, and
they have.
If you're watching this, you've been experiencing that as well, hopefully. So it's been great, but beyond hitting that target number in the 401k balance, if you hit that target when you're 50 years old, you're going to have a number of different hills that you still got to climb in order to have a successful retirement, because you're not actually able to start drawing from your different retirement accounts at that age, right? So I wanted to mention for 401ks specifically that there's a unique rule. Like if you retire from a company and where you've got your 401k at 55 or later, then you're able to start using those funds to help fund your retirement expenses. you
Interesting.
are still.
And what if you're not? If it's just a regular retirement account, not a 401k?
Yeah, so if it's not a 401k, like for what we're generally managing for folks is their traditional and Roth IRAs, that is going to be at 59.5 before you can start making those distributions penalty free. Now there's still tax implications depending on how long you've had the account open and what the account type is, but 59.5 is what our clientele are going to be subject to before they can make those distributions without that early distribution penalty.
And what is that early distribution penalty?
So for those accounts, it's 10%. Prior to age 59.5, you're going to have a early distribution penalty on top of the income tax ramifications. So it's not the end of the world, but it is still something you need to be factoring in if it's something that you're planning to do. And one of the best things here is sometimes folks have to for different reasons to get into those accounts early. There may be other exemptions that you would qualify for. Those vary and aren't consistent throughout history. So the exception list now is a little bit broader than it was before. But again, generally speaking, 59.5 is that big number before you can start taking out those distributions without having that 10% penalty on top of income taxes.
Yes. Shall we dive into some other important numbers then?
Yeah.
Big numbers, big dates, big ages, because that's one thing. I mean, it could be something now, but a few years from now it might be changed. But anyways, I think going into it, some other big ages that people should keep in know, just because I feel like there's so many different ones that it can be a little confusing.
Yeah, great question. So, another one that's going to come up that folks really have to think about, especially when you're looking to retire early, is that Medicare eligibility age. So 65 is the target there. So once you're 65, you're going to be enrolling in Medicare unless you're still working and you have a type of insurance through work that qualifies you to delay enrollment. It's not really across the board. So most folks are going to need to be enrolled at age 65, whether they're working or not. Mm-hmm. Some folks are going to have an exception that's limited. So at 65, then you get on Medicare. But for that person that has done really well investing and saving a lot in their retirement accounts over time, if they retire at 50, they've got to go into the marketplace or have another answer for how they're going to have their health insurance covered up until they get to Medicare eligibility. So that's one of the things that we're able to work with folks on, come up with a strategy, see if they're going to be able to afford that specific expense on top of everything else they're looking to pay for.
That's something very crucial to know. And so I guess just going up the timeline there, after 65, what are some other important dates to be looking towards?
Well, 65 is a key for Medicare purposes, but beyond that, the Social Security is the other big one, and we'll probably end up doing multiple episodes just talking about Social Security. But for most individuals or families, you're looking at starting your early Social Security benefit as early as age 62 or as late as age 70. So if you're right in that sort of range right now where you're contemplating Social Security, your full retirement age is almost certainly going to be 67. All right. Mm-hmm. So at 67, that determines what your full retirement amount is for Social Security purposes. So one of the things that most people don't seem to understand, I've had to correct people on this a lot of times since I've been here, is that just because you retire at 63 or 64, whenever it is, it doesn't mean that you have to start your Social Security benefit right when you retire. Mm-hmm. It may make sense for your plan, but it's not a requirement for you to just cut off your paycheck, stop the work that you've been doing all these years, and immediately enroll in Social Security. When folks have other resources and have longevity, different factors can come into play where it may make sense for them to delay Social Security. So there may be a gap between when you stop working, in your earlier 60s or even younger for some folks, and when you actually start taking your Social Security benefits.
That is the biggest difference, just between 62 and 70 of the benefits is just how much you get, essentially. Correct?
Yeah, it's pretty meaningful too. So the way the math kind of works out, you really are thinking 8% per year from delaying that benefit from 67 to 70. So you're talking about an extra 24%. Wow. That your benefit is just going to be accumulating on top of the inflation adjustments that happen each year as well. Mm-hmm. But it's a pretty meaningful difference. Have that extra 24% of income that could potentially last you 20 to 30 years, and then the bigger piece that comes into play is actually when there's a earnings variation between spouses, right? So if one has been earning significantly more than the other, that benefit's going to be a lot higher in most situations. So it could make sense for that higher income earner to delay their benefit because of the spousal benefits that their spouse might be entitled to currently when they are both enrolled, or down the road for survivor benefit purposes.
Okay, interesting. So. And there's so much more into Social Security that we will get into further episodes. But going past that, then there's definitely a few more different ages. So let's talk a little bit about RMDs and QCDs. Okay. Just not necessarily going into them, but just the age dates of that, because that's one thing RMDs have. That's required minimum distributions for those who don't know. That's something that's changed a lot since COVID and everything. Just briefly touch on that. Yeah.
So the 70 and a half, and we need to look at the history of how that number came to be, but that was the age that people had to get to when they had to start making these required minimum distributions. If you're not familiar with that, then you're pretty young and very fortunate, and we're glad to have you watching the show. But once you get to this age where you have a required minimum distribution, that means you've got to take money out of this account that's been growing over your working history. You've got to take money out of this account and pay income taxes on it, whether you need that money or not. Right, so there's no real option there. You're going to end up having penalties if you don't take it out. So you're going to have to do those required minimum distributions once you reach that certain age. So it was 70 and a half for a long time prior to COVID, and it has moved a few times. So it was briefly age 72. Folks would have to start doing their benefit at 72. That was only about a year or so. And right now, folks, it's for age 73. Mm-hmm. So at age 73, you're going to have to start taking a percentage of your tax-deferred assets out, paying income taxes on it. And it's going to change again, actually, in 2033. It's moving out from 73 to age 75. So for folks that are, just turning 73 in 2033, they won't have to do a required minimum distribution until they're a couple years older. So that's whether you need those funds or not. Mm-hmm. That is different from any sort of Roth money. That's one of the biggest things I end up working with folks on is making sure they understand the importance of Roth accounts, because they do not have required minimum distributions regardless of age. So we won't go down that hole too much. But
no. We had a previous episode on a little bit talking about Roths, but yes, just since it's all after tax money, Uncle Sam doesn't need to get his cut because he already got his cut. That's one of the main reasons of RMDs. But
and there's a lot of question marks around the viability. Is it best for the government? Is this going to be around forever? Mm-hmm. Most of you folks, if you're considering retirement, Roth wasn't really an option for you throughout your working career. It was introduced, and a lot of plans didn't even start offering it even once it became available. So it's still something where we're trying to educate folks on. But yeah, you pay income taxes on that up front, and then it gets to grow. Theoretically, it's going to grow for a long time, and you don't have required minimum distributions on it down the road.
Okay. And just, I guess, to wrap things up here, touch briefly about QCDs, qualified charitable distributions. And that's something I think we'll definitely have a whole segment on that, but just for the timeline reasons.
Yeah. So the required minimum distributions and the qualified charitable distributions, that they both used to start at 70.5. And while they've moved the bar for when you start those required minimum distributions a few times, the qualified charitable distribution still starts at age 70.5. That's when you can start making distributions out of a 401k, out of an IRA, and start making those distributions to qualified charities without paying the income taxes on that. So you would not be subject, like you can do up to a little over 100,000 right now per year, right? So you can take that out and you would not be responsible for income taxes on that distribution. So that still starts at age 70.5. It can be a great part of your overall estate plan. If you've got charitable aspirations, that's something we are very fortunate to get to work with a lot of folks on. Mm-hmm. Helping them take advantage of these different ways to be charitable. So there's a lot of better ways of going about being charitable instead of just using your checking account, or using cash. We want to take advantage of the opportunities out there tax-wise. So whether that be appreciated assets, right now, or using those qualified charitable distributions is a great way to still fulfill that charitable aspiration while taking advantage of the current, tax advantages of doing it other routes.
Perfect. Well, that's just, rounds up everything for the main timeline for retirement ages and dates. So is there anything that you would, just to wrap up here, any common misconceptions or anything that you would have for last advice just with these dates for clients, prospects, whoever's listening?
Yeah, I think the biggest thing there, I can't remember if you've already done an episode on this, but the target retirement funds, I've got a lot of qualms with those. But the big thing that people come in, they think that they're a certain age, so they need to be more conservative with their assets. And I tell folks that, I met with teenagers and people in their early 20s that are super nervous about markets for different reasons, and they want to be more conservative than I would recommend. And then I've got folks, actually had a client when he signed up when he was 100 years old, and he was still all stocks. So it really is dependent on what those long-term goals are. What is it that you're trying to accomplish? Just because you're retiring doesn't necessarily mean that you need to be 50% fixed income or be in all cash. You're hopefully going to be looking at an opportunity to retire early and still have your golden years available. So you want those assets to keep working for you. So I would say that's a common misconception. People retire that they need to be more conservative than is necessarily going to be beneficial for them long term.
That's great. And that's one thing you were talking about, the target date funds. That's something specifically typically in 401ks is offered, and it gets more conservative the older you get as you reach that target date. And that's something typically we won't go too deep into it, but it gets way more conservative than that should be prior. So yeah, when you're retiring, you're not making what most likely should be. So anyways, that's great. Well, thank you. We thank you, Matt, for joining us this week, and this great knowledge here. So to wrap things up here, we're going to do John's pick of the week this week. And this week is something that I've been doing here for a good little while. It's weightlifting. The benefits of it, just exactly, that's something that just keeps you active. I've been weightlifting, I think, since freshman year in college, so it's been 6-7 years now. And it's something, I only lift weights about 3 times a week now, but it does it good enough. Specific studies-wise here, we'll just get into a few statistics. People that lift weights 2 times a week have a lower risk of mortality by 46%.
Wow.
And it's not too shabby. It's lifting weights twice a week. And that's something also, once you hit your 30s, you start losing muscle mass like 2 to 8% per decade. And it's shown that the only way to combat that is just with resistance training. That's just a little bit of something. It's not too hard. With weights, you can lift for 30 seconds, you got a little bit of a break, and you go back to it and everything. It's easy, simple going, and it just, I know you played college football, and so you have lifted weights off the wazoo, and
so trying to avoid getting my boys started on it too young, but it's great thing to do. Builds a lot of character. And being in the weight room, and it's just one of those things that provides the benefits for longevity. So love it. What are some of your favorite weightlifting exercises?
Hands down with chest, I would say chest. I like dumbbell bench the best, probably. Barbell is good. I just typically don't have a spotter, so I don't want to choke myself. But that's always been one of my favorite. Pull-ups are fun. But what about you?
So the full body workouts, it took a long time for me to really appreciate it. But when you're doing a deadlift or you're doing squats, those are really like full body workouts. The chest is important. People want to be strong. You need to recommend for functional strength. The squats, deadlifts, great. Full body exercises, you're triggering a little bit of everything, and getting to burn a lot of calories in the process. Those have tended to be my favorites. I actually really got into hang clean when playing football. You're typically your instructor is either going to be very heavy into hang clean or power clean. I like hang clean a little bit more, but that's what we did in high school, and we won a lot of games, so I've just always used that philosophy. So
that's great, and that's a little bit more action too than just a typical in the set. So that's fun. It's great. It's just something just to keep it a staple. And once you build that muscle, if you lose a little bit, it's so much easier to build it back because it's kind of muscle memory. But
well, that and when you're exercising and you're doing things like weightlifting, it means that you can eat more, right? So it's an offset. So
good point. And it's a necessity for me. For the both of us. Anyways, well, thank you again for coming in, and you'll definitely be back here soon. So as always, we like to finish things up with our motto, and thank you all for listening. Always buy quality and diversify. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice, a recommendation to buy or sell securities, or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involves risks, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional before making any investment decisions.